Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. What does a global investment giant look for when building a portfolio of companies to deliver returns? Well, according to the international equity team at Morgan Stanley Investment Management, the key is well-managed companies with sustainably high returns over the long term. It also helps to be patient. Along with its affiliates, Morgan Stanley Investment Management has more than $1.5 trillion in assets under management of supervision. Remember, the following conversation is general information only. You should always seek professional advice before making investment decisions. Today, I'm joined by Bruno Paulson, Managing Director of Morgan Stanley Investment Management's International Equity Team, who's visiting Australia for a few days. Bruno, welcome to Fear and Greed.
Thank you. Great to be here.
I want to talk about the idea of compounding returns on equities. We all talk about compounding interest being, one of the great investment tricks of all time. But you talk more about compounding returns on equities. Just explain what you're talking about.
So it's about investing in companies which steadily deliver year after year. So if you have a portfolio of companies that can grow at mid-single digit, 5 to 6%, maybe squeeze a bit of extra margin, and then have the cash coming back, which in terms of dividends or buybacks, the 6+4, or if you can find companies that compound at 10% across cycles, then over 7 years, you double, rule of 72, 14 years, you quadruple. And so it's finding the companies, it's not looking at things which double in a year or do anything spectacular. It's looking at the companies where the underlying companies steadily compound over time. Valuations move up and down, but if you're compounding over time, that will dominate over the long run. And that's what our global portfolios have been doing since 1996.
Okay, so typically, what sort of companies are they? Are they from different sectors? Do they have certain traits that are similar across the board? Just explain how you think about these companies and how you discover them, really.
So we're looking for companies which are very profitable and grow steadily with strong intangible assets. That can be brands or it can be networks. And those will give you pricing power, which defends you. And we also love recurring revenue. That might be from a 25-year contract on an elevator or a long-term cloud contract or just going and always buying the same shampoo. So it's high returns on capital, pricing power, recurring revenue, not too much leverage. Run a simple screen to find profitable companies, then think very hard about which ones are A, going to stay profitable, and B, the management aren't going to mess it up, and C, don't pay too much.
Okay, so intangibles is an interesting one because we seldom, whenever we're talking about it, people downplay intangibles. But what you're saying is very important. So a company like Revlon or Nike, and I'm not suggesting that you do or don't invest in any of these, but that it's kind of those brand names that actually do matter a bit.
Yeah, and we're not invested in either of those at present. But these brands have often been built up over decades, or in some cases centuries, of loads of investment year after year after year. It's not on the balance sheet because it just goes through the P&L. And that gives a significant barrier to entry, just as a network, everyone using Excel because everyone using Excel is a barrier to entry. If your assets are tangible, you have a factory, you have a mine, then that's quite easy for other people to imitate. Whereas these intangible assets are much more difficult to imitate and give potential barriers to entry.
So startups are less likely to be part of your portfolio, for example?
Absolutely. We want long-term proven winners. Sometimes the companies may be relatively young, like Haleon, which spun out of GSK or Pfizer, but you have the long-term data for those companies over longer. We want proven winners we believe are going to keep winning.
How do you think about the tech stocks then generally, because that's a sector which rises and falls or has risen and fallen sometimes to sort of an extreme extent? How do you think about those companies?
So about a quarter of the portfolio is in tech, but tech covers a lot of different things. So there's hardware and semiconductors, and there's software and services. We're skewed towards the software and services. We like companies which particularly set of business-to-business companies, and that they're steadier and less spectacular. Your Microsofts, your SAPs, your Accentures, they're amongst some of the largest holding the portfolio. And that they're not at the most exciting end of tech. They are already profitable. There's a lot of unprofitable companies in tech, particularly amongst the younger companies, particularly once you charge them for share-based compensation. So we avoid those companies. We want the established profitable companies, which aren't as volatile as some of the ones you're describing.
But Microsoft, so NVIDIA as an example, and again, we're not saying you are or you are not investing in NVIDIA, but how would you think about a stock like that goes so hard? Because then you have all sorts of valuation risks. But what you're saying, that actually, because you're talking about compounding return, so if it's continuing to make money, that's okay.
So NVIDIA is a genuinely profitable and amazing company. The issue for us is around the uncertainty about the future profitability. How fast will AI go? I mean, I think we agree that Gen AI was going to be a significant force, but how fast will those revenues come through, which eventually feeds through chip revenues, and will they remain dominant? Those are two significant uncertainties.
Stay with me, Bruno. We'll be back in a minute. I'm speaking to Bruno Paulson from Morgan Stanley Investment Management. Okay, so let's move away from technology. What about miners? It's such a big part of the Australian index are the miners. How do you view miners? Because again, commodity prices can be very volatile.
This is something we do not go near thinking about approaching investing in our portfolios.
Right.
Because we want companies which are high return on capital, not cyclical, and are price makers, have some pricing power. Commodity companies are very low return on capital, they're very cyclical, and they are price takers. And so, asking what the BHP, whoever it is, what their profit's going to be in 5 years, you want to know what the iron ore price is. You want to know. You just don't know, right? They don't have that control over their destiny, and are volatile. We want the companies to have some control over the destiny, and you have a far higher level of confidence of what the economics are going to look like in 5 years. So, if you were going to describe the opposite of what we invest in, it would be a miner or a bank.
Oh, no, you've really thrown it, because we are Australian here, and you've thrown the banks in, which, of course, as you would know, our market is dominated by the banks at top 10. So why not? Some of those have great brand names. They probably don't have a high return on capital.
They've got great brand names. They do not have a high return on unlevered capital.
Yeah,
we're looking, our portfolios, the unlevered, important word here, unlevered return on operating capital, this is ex goodwill and things, for our portfolios is the order of 50 to 60%. Banks will be, a well-run bank and a decent year might be at 1.
Yeah.
So they're only 50 times short, because to get to a 15, 20% ROE, they're levered up 15 times, which means when things go wrong, they go 15 times more wrong.
Yeah.
And so it's the exact antithesis. We want companies who are very, very profitable and high returns on capital without using leverage. Banks, by their nature, use enormous amounts of leverage, which is fine on the way up. It's less fine on the way down. And it does make what we do quite diversifying for people with Australian portfolios, because we don't do mining or banking.
Yeah. So tech stocks are a quarter of your portfolio. What else is in that portfolio?
So the tech stocks skew towards the services and software I mentioned. Then you've got healthcare, not the pharmaceuticals, because you're profitable because the patents expire. And so the reason you're profitable goes away. Remember I said we pick profitable things and then think hard about where they're going to stay profitable. The reason then you're just hoping they find another patent. So it's the life sciences and equipment and a few providers. So that's the healthcare. You then have financials. And you're saying, what do you mean financials? You just said you hate banks. There are financials which aren't really financial. You have payments like Visa. You have exchanges, ICE and CME. You have the insurance brokers like Aon and AJ Gallagher. So you have these companies which don't have balance sheets. So we like the financials which don't have balance sheets, these niches within financials which don't have balance sheets. You then have industrials, but again, it's not the dirty, heavy, grimy industrials. Yes, we like elevator companies because, as I mentioned, they've got the 25-year contracts, service the lift.
Yeah.
You don't make much money making the lift, installing it, but then you get the 25-year contract to sign it. But then it's information companies like, Relx or credit scoring, credit rating, ADP, the payroll provider in the US. So it's capital light and also carbon light, as it happens, companies.
One final question, Bruno. How do you get your head across all the companies that you have the potential to invest in? Because I often think it's interesting in the Australian market, which is relatively small in terms of the number of stocks that are investable, at least. I'm amazed at how our analysts get across all of them. How do you, though, Bruno? Because
we cheat. We cheat. Our cheat is because we're only looking for we're only looking for the proven winners. And so you start off with a couple of thousand. reasonable size. We run our quantitative screen looking for high returns of capital, not too much capital intensity, nice fat gross margins, not too much leverage. And even before you start thinking about valuation, you're down to a few hundred. And then it's within those, you're looking at those. We have an investment team of 15 people, experienced investment team of 15 people. And our universe is shrunk. So we're able to focus on those companies which make it through the screen, some of which we will reject quite quickly. And so we're on the areas and sectors which are interesting and potentially interesting, we're able to focus in quite closely while not worrying about the iron ore price. That's not our problem.
Yeah. Bruno, thank you very much for talking to Fear and Greed.
It's been a pleasure. Thank you for your time.
That was Bruno Paulson, Managing Director of Morgan Stanley Investment Management's International Equity Team. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.